Brian Bushlach is back with Business Briefing on FM News 101.
Well, we're taking a football hiatus this weekend here on Business Briefing. We're focused on business as we wrap up the first month of the year. Hard to believe. A week from today, January is history. We're into February. It's Super Bowl Sunday, and we have the best of Business Briefing coming your way next weekend, because I know as much as you love this show and you tune in every week, that little football game takes precedent. I don't blame you. Best of Business Briefing next weekend right here, same time, same place on Business Briefing. Tax season just around the corner. I know, it's time to start thinking about taxes, and that's why we call on one of the top CPAs in the entire region, just named to the Portland Business Journal's 40 Under 40 list. Congratulations to our good friend, our colleague, Michael Lortz from Geffen. I sat down with him at his Portland office this past week to talk about the upcoming tax season and reflect on some changes that may be coming our way. Well, Michael, good to see you. And the State of the Union, usual rhetoric. What's the chances of any of that getting passed?
Well, there were a number of tax proposals, Brian, that the president talked about in that address, and they kind of spanned the gamut. There was a proposal that relates to what happens when people die. There was a proposal to increase capital gains rates. And there were also some enhanced tax credits for some folks, the consolidation and elimination of some college savings benefits. At the end of the day, quite a few of these changes will be unpopular with the Republican Congress. They've already made that clear. And so I think the odds of these things happening are very, very low. Maybe there would be a compromise that would incorporate some of it, but that seems doubtful at this point.
You know, we heard from Pat Stone earlier in the show, and oftentimes he'll talk about what the tax structure was like in America back in the 70s. And he's like, hey, if you think it's crazy now, you know, he'll throw out numbers where you're just like, wow, I had no idea, because, you know, our generation was not exposed to that. But, I mean, it definitely could be a lot more challenging, I guess, if you will, couldn't it?
It could, and folks are pretty quick to point out that the new 28% capital gain rate that the president has proposed, that is the same rate as existed during the Reagan administration. So we've certainly been there before. On the flip side, when the president first came into office, that rate was 15%. So going up from 15 to 28, that's a pretty big jump.
Yeah, I mean, you got to put it in perspective, because we had extremely low rates throughout the Bush years, didn't we?
Absolutely, we did. And they've already increased those rates over time to some extent. So right now, the top capital gain rate is 20%, plus we have a 3.8% surcharge that was part of the Affordable Care Act.
One thing I want to ask you, we talked about this just before we hit the record button here, but there's always that talk, you know, when it comes to the estate tax and the 1%, and this is not a political show and we're not making a statement, but I do want to point out that, you know, I saw that article on Bloomberg. I tweeted that out this past week, you know, about the estate tax, and there are so many tools for the wealthy to use to avoid it or get around it. And I'm thinking, you know, that's not necessarily the case, because we know you work with high net worth clients, and so do I. There is a certain amount of planning you can do, but ultimately you get to a point where you're capped out on your exemptions. You are going to pay it, whether it's a life insurance trust or flat out writing a check, right?
Yeah, I would agree with that. You know, certainly we work with clients to help them reduce the amount of their estate tax liability, but there's not a magic bullet. It's not as if we're making that go away. We might be able to reduce the effective rate through some planning techniques. Maybe they can, as you say, use life insurance or some other strategy or approach to help mitigate the impact, but it's not as if that number goes to zero. Our clients are still paying a significant amount of money in estate taxes.
Michael Lortz at Geffen joining us here on Business Briefing. It sounds to me, from what we can see politically and, you know, tax-wise, really probably not a lot of volatility the next couple of years. Sounds like it's kind of just going to be stuck pretty much where it's at, right?
Yeah, that'll be really interesting. You know, it's really hard to say what will happen in Congress this year. I think most people predict that in 2016, both parties will be gearing up for the big presidential election, and so it would seem unlikely that anything would happen in the final year of the president's term. 2015 is a little bit up in the air. Both sides have talked about tax reform. Now, they approach it very differently. It's possible that they could come to some sort of agreement. But if I was a betting man, I would bet that they can't.
That's exactly what it comes right down to it. Yeah, we don't want to put any chips on the table on that one. Let's shift gears, Michael, and talk about year end. And it sounds to me from what you've shared that pretty much status quo heading into 2015.
Yeah, so year-end tax planning this year was very interesting because for a lot of our business clients or real estate investor clients, we were in a situation where a number of tax provisions had expired at the end of 2013, and both political parties assured the public that many of those provisions would get extended, but they kept not doing it and not doing it. So after the November elections last year in 2014, finally, Congress and the president figured out how to pass an extender bill. And to make a long story short, they basically took all of the 2013 tax rules and extended them into 2014. However, they did not extend them into 2015. So we're just in the same situation as we were 12 months ago. We don't really know for sure what the 2015 tax rules will be for things like depreciation expense, things like the research tax credit, things like individuals being able to transfer money from their IRAs to charity in lieu of required minimum distributions. Those rules are up in the air all over again.
Here we go again. Congratulations, 40 Under 40, Portland Business Journal. You're one of the top CPAs, a partner here at Geffen Mesher. And this is not a tax or accounting question to wrap up the segment. It's more of an overall question on the businesses you work with, the business leaders you talk to on almost a daily basis. Here we are in the outset of 2015. Things seem to be on the upswing, pretty positive. What's the word on the street?
Yeah, you're right. It's been very interesting. So many of the businesses we work with are expanding. A number of them are opening up other offices in other markets as they try to expand their geographic footprint. On the real estate side, we've seen a lot of deals happen this year. Even 6 months ago, I was being told, things are heating up, but we just can't find anything to buy. Sure, it's a great time to sell, but we can't find anything to buy. Well, that's changed. We are seeing people very active in the real estate world buying and selling again. So lots of activity. It seems like things are pointing up, at least for now.
Always great to hear from Michael Lortz. If you'd like to contact him, email mlortz@gmco.com. More business briefing after a break.